Overnight, we did see some big economic news break out of China. The inflation rate in that country reached a 16-month high, which might, some say, force the government there to cut back on those stimulus measures. The number was 2.7%. That's just below what Premier Wen Jiabao's target rate was for the year. So we want to find out what's next for China. No better person to speak to than Stephen Roach of Morgan Stanley Asia. Thank you so much for coming in today.
Good to see you, Margaret.
Good to see you. I mean, exactly here, 2.7% sounds very close to that 3% target. Does that mean we're going to see a policy change next month?
Well, first of all, the comparisons, Margaret, on inflation, exports, industrial output, GDP, they're coming off of rock bottom levels from a year ago. And so China's clearly mindful of the fact that as the global economy bounces and this export machine is a levered play on the global economy, it's going to bounce as well. Looking beyond the first half of the year, I think China still has a lot of questions about economic prospects going forward. They're not going to be aggressive on policy here. But yes, they're prepared to begin to head to the exit strategies. They raised bank reserve requirements twice in the first 2 months of this year. They may make a small move on the currency. They've indicated that they're not going to be increasing their fiscal stimulus going forward. When you have a strong economy, you do not need emergency measures on the fiscal and monetary front to support it, and the Chinese are mindful of this.
Would April, which is the month that keeps getting repeated in terms of a potential policy change, when you talk to a lot of strategists, would that be too soon?
I think April is also the year when the U.S. issues its twice yearly foreign exchange report. The Chinese want to avoid being labeled a currency manipulator. They may make a small move on the currency. I think it'd be premature for them to move on interest rates at that point, but certainly they could do more in the way of curtailing excess bank lending by further increases in bank reserve ratios.
Yeah, because certainly the headline of a 16-month high sounds scary there. But do you think those concerns and the reverberations we've seen in the emerging markets in today's trading session, do you mean that it's sort of overdone, too much of a knee-jerk reaction? Yeah,
I think, the idea of a 16-month high is, again, you have to put it in context of where we've been over the last 16 months. This has not been a great 16-month period for anyone. China's been more resilient than any other major economy in the world, but the idea that this is an overheated economy, I think, is very much overblown.
You mentioned perhaps a small move when it comes to currency. When you look at the yuan, the question is how much of a move would the Chinese government allow if they do allow the yuan to appreciate?
Hard to know, but my guess is somewhere in the 2 to 3% area would not be unreasonable. Whatever the move is, it's going to be well short of that of the sort of Washington politicians who continue to beat on China for a big move. This is a country that still remains very dependent on the export machine to sustain economic growth, employment, and maintain social stability.
And you're concerned about protectionism. I remember a conversation we had a few months ago where we started to see that bubble up a little bit.
Look, the developed world has still got a 10% unemployment rate, relatively stagnant real wages for its workforce, and they believe that China is responsible for a lot of the pressures bearing down on its workers. As we go toward the midterm elections in the U.S., the protectionist drumbeat is something to take fairly seriously.